The program that we'll be talking about today over the next hour is one of the fastest growing crop insurance products in the Northeast and the U.S., and that's the Pasture Rangeland Forage program. This is a program that, from a crop perspective, forage producers, hay producers have not had an adequate crop insurance policy in place, and the Pasture Rangeland Forage program has certainly made its way to providing value to producers. Giving a little perspective over the Northeast and how the Pasture Rangeland Forage program has grown in acres insured. Since 2014, there were 70,000 acres in the Northeast covered. Today, there's over 120,000 acres protected. And one of the studies that we completed earlier this spring was to identify how many acres of hay and grazing land had been uninsured, and we identified over 4 million acres that do not have protection on it. And one of the items from a livestock operation perspective or a hay operation, there's significant amount of exposure there. So as we move towards the 2019 crop year, having the Pasture Rangeland Forage program available to us and visiting with producers to put a plan in place that will help them protect their feed costs, protect that hay crop, we certainly have a significant opportunity there from a producer perspective as well as a farm credit perspective. The 4 million acres that are identified as uninsured acres in the Northeast results to being almost $170 million in premium available to us. So while we have significant opportunity to protect our livestock and hay producer operations, we also have an opportunity to grow our crop insurance program. Our presenter today is Debbie Swarz. Debbie is with Diversified Crop Insurance Services, and Crop Growers works with 3 insurance providers, and Diversified Crop Insurance Services is one of our insurance providers that we use to deliver the crop insurance program. Debbie grew up in south central Illinois on a corn, soybean, and wheat farm. Her grandparents were dairy farmers, and her cousin still manages that dairy today. Debbie has her master's in communications and public relations from the University of Illinois. Prior to coming to Diversified Crop Insurance Services, Debbie was an insurance agent serving Colorado, Maine for a number of years before returning back to Illinois to be closer to her family. In her free time, Debbie spends time with her family on the farm as well as playing with her nieces and nephews. And Debbie is also a St. Louis Cardinals fan and an avid photographer. So we welcome Debbie to the webinar. And before I turn it over to Debbie, please, as we move through the Learn at Lunch here today for the next hour, text chat in your questions. And as we're moving through the presentation, we'll try to respond to them. If we have to, if we get to the end, we'll certainly make sure that we answer everybody's questions. But again, thank you for joining us today. We look forward to the next hour. And with that, Debbie, I'm going to turn it over to you. Welcome again.
All right. Can you hear me okay, Jeremy? Just want to make sure my audio is working fine.
You are. You're coming through clear. Thank you.
All right. Super. Yes, thank you for having us. I'm going to spend a little time on the Pasture Rangeland and Forage. We do call it PRF for short. And yes, I am based out of Illinois, but I travel across the country working with agents and producers on a number of crop insurance products. So that's kind of a little bit about my background. So just to give you a high level on the Pasture Rangeland and Forage, or the PRF, it's a lack of precipitation policy. So it provides coverage for lack of rainfall, lack of snow, and it's in what we call a grid location. Those grid locations are roughly 17 by 17 miles, not quite exact, but it goes by latitude and longitude. The globe is in a circle, so some of those areas might be a 12-mile by 12-mile, some are up to a 17 by 17, or any variation in between. This policy does not provide coverage for that particular farmer's, I guess it doesn't matter what happens to the rainfall in a particular producer's, at their farm. It's measuring the rainfall in that grid location. And we'll talk about those grids in a little more detail. So individual rainfall at a producer's house doesn't really matter. It goes on what happens in the grid. There's no loss adjustment that we have to do, so the producer doesn't have to provide records. They don't have to contact or call us to say, hey, I think the rainfall was too low to have a payment. The government just sends us a report and says in these grids, the rainfall was below what the average was, and we issue those claim payments. So we'll talk about how those get paid and when they get paid. So why would someone look at buying a pasture rangeland and forage policy? If you're expecting below normal rainfall for the 2019 calendar year, this might be a good opportunity. It's also a great way for producers to offset any below normal hay production or any less than desirable grazing opportunities. So regardless of a producer's hay production, they may or may not have an indemnity. So a producer could have 3 cuttings of hay, and if our rainfall, let's say the average rainfall in a grid was 5 inches, if there was only 4 inches of rain reported, which would be less than that 5-inch mark, then an indemnity would be, check would be cut. It doesn't matter if that producer had a cutting of hay or not. It just looks at lack of rainfall. Again, no loss adjustments, and this product is highly subsidized, which makes it very attractive to producers. They don't have to pay the full premium. The government's kicking in some of that subsidy for them. There's 2 types of products or 2 options that a producer can pick under the Pasture Rangeland and Forage. One is grazing and the other one is haying. On the grazing side of things, this particular crop has to be established acreage for perennial forage. It has to be intended for grazing. It needs to be used solely as a pasture for livestock to run and to roam and to feed on. It must be suitable for grazing, and it has to be planted prior to July 1. So in simplified terms, for a producer standpoint, I'm pretty simple, but to me, grazing is going to be your basic grassland. It's probably going to have a fence around it or the ability to put up a portable fence. And you could run cattle on that ground, horses, sheep, goats, anything, any kind of animal could graze on that opportunity. So that's it must be intended to graze. It doesn't mean you have to graze anything on that land, but the intent is at some point during the year, I might have cattle or horses running on that particular piece of ground. On the haying side, the other opportunity is that I have to establish acreage for perennial forage. It has to be intended for haying, and it must be suitable for haying. And basically what that means is you have to be able to run a machine across the field in order for it to be considered hayland. It does not include earlage, green chop, any kind of grain that would be fed for livestock or silage. And it also has to be planted prior to July 1. You can have, let's say a producer has 3 or 4 fields. They could put some of those fields in grazing. They could put some in haying. You cannot have haying and grain on the same acreage. You have to pick one or the other. The other thing to note here is that you do not have to insure 100% of your acres. So if a producer has 100 acres, he could say, well, I'm not super happy with the premium. I just want to insure half of those acres, and that's totally fine. And that makes this program a little special because usually if you're insuring your crop, you have to insure 100% of that crop. Let me pause there and see if Jeremy has any comments to add on the haying and grazing, and we'll see if we have any questions.
Let's see, Debbie, no questions have come through yet, but on the haying and grazing, typically in our area, we'll see a lot more hayland acres than grazing acres. So you mentioned that it's based on the intent and what the producer is going to do with that ground. So I would say many of our producers also work with the Farm Service Agency. So based on that, if they're reporting that ground as hay ground to FSA, that's what they would insure it as, is under the hay type coverage?
Correct.
Is that correct?
Yeah, that is correct. Yep. And we would encourage producers to go into FSA, report it as either haying or grazing. We do have to do an audit on 3% of the policies, and basically we're checking to see, is this really hay land or is it really grazing land? So, yeah, I think in your area, a lot of the ground that you're going to see is going to be the hay ground. The hay ground, the premiums are going to be a little higher on the hay ground than they are in the grazing, and typically that's going to be because your hay ground is much better quality ground. You're typically getting hay off of that, which you could sell or use for feed, and the grazing is your less quality ground. A lot of times you just run cattle or horses on it just to feed on the grass. So anything else there, Jeremy, from your end?
Nothing more now.
All right, so let's talk a little bit about that precipitation. The precipitation is documented by NOAA and the National Oceanic and Atmospheric Administration. So this is a government agency separate from the RMA or anything on the crop insurance side. They update the data daily, and we have data that goes back to 1948. So this is probably the hardest thing that producers need to wrap their arms around, because the question always is, well, I have a rain gauge in my yard and I know how much it rains at my house, but what is NOAA really saying? Well, in a particular grid, NOAA may have 10 grid locations or weather stations. They may have 10 weather stations, and each of those weather stations reports for an interval or a time frame. If at some point we don't know exactly where NOAA has those weather stations, and that's on purpose, a number of reasons. Number one, they don't want people to go out and knock over the weather station or dump water in it or mess around with it to alter any of the results. They also have those weather stations, so if one doesn't work for a period of time, they kick that data out for the month, let's say. So for the month of January, let's say you have 10 weather stations and 9 of them work, one does not. The one does not work, they kick that one out and they only use 9 weather stations. In February, maybe they use all 10, or maybe they added 2 more, so now you have 12 that you're looking at in the grid. So those are changing constantly, and that's kind of the hardest one, I think, for producers to wrap their arm around. But this is no different than a county yield number or county numbers in the crop insurance world that the government gives us that says your county yield on corn was this number, and that's going to be different than what the producer actually produced on their location. But NOAA does provide us with some weather maps. We can go out and look 6 months into the future of what NOAA is reporting as far as weather, what they're anticipating, whether it's temperature or precipitation, drought, things of that nature. So we do have those tools available, and that's how the precipitation is reported. When it comes to snowfall, they do measure snowfall as well. If we get a heavy snow, that's melted down, and you're going to have a higher water content than if it's a light snow, which would be a much lower content. And all of that snowfall goes into rainfall numbers to come up with the total precipitation. Jeremy, any comments there from you on the NOAA information?
Debbie, one question that came through was, is there a minimum number of weather stations needed to track the moisture in a grid? And I'm not aware of that. That's a good question.
No, I don't think there's a minimum number. The information says that if there's a grid that doesn't have a weather station, they pull from the nearest. So they have data. In New England, it's probably not such a big issue. There's a lot of weather stations. Out west, there are some places where it's very hard to get to. If you think about Colorado, Utah, Montana, areas like that, sometimes the locations are pretty big and it's very difficult to put a weather station on top of a mountain, for example. And so some of those they may pull from the next local one, but I don't think there's a minimum as far as where the weather stations are. So any other comments or questions?
Not on that, Debbie.
All right. Moving right along. So kind of talking about the grid location, the other neat thing about this policy is to start out with the example here on the screen, you're going to see that the green area here, this is a 17,000 acre ranch out in Texas. It's some dummy policy out in Texas. And these blue lines are your grid locations, and so, or a NOAA grid number. And so the producer can pick, if they're crossing grid lines, they can pick to put their acres in that northern grid, or they can put all their acres in the southern grid, or they can split their acres between the two grids. And again, they don't have to insure all their acres. So on the 17,000, they could say, well, I want 5,000 in the north, and I want 10,000 in the south, and 2,000 that I'm not insuring. So there is a lot of flexibility, or they could say, I want all 17,000 put in that south grid or in the north grid. So a lot of flexibility there. The RMA website has an opportunity where producers can go out and they can type in an address, like we just put in the town of Ogden, hopefully I said that right, New York, and it will automatically give us a grid location. And we can scroll in and get down and identify where those fields are located and in which grid number that they are found. So comments there on the grids, Jeremy, or questions?
Well, we do have a text chat question that just came in, and it's, can we insure ground that will be used for haylage?
Jeremy, do you know specifically? We may have to check with the actuarials.
And that's anything unique to the haylage. I'll ask, who text chatted that in, do they want to give us a little bit more information on what's going to be harvested? So I'm leaning to yes, but I'm hoping that there's a little bit more to that. While we're waiting to see if they add more to that question, Debbie, you mentioned, so a producer that has maybe 500 acres of hay in a grid, that producer doesn't need to insure all of that 500 acres, right? They can insure
Correct.
100 acres of that if they choose, if they've got better ground, if they've got some ground that is highly productive and ground that, some poorer ground, they can choose to insure that highly productive ground, right?
Yes, that's correct. Let's say a guy has 5 fields and 2 of those are really productive and 3 are not. He could choose to do the 2 that are really productive and just ignore the other 3. We would document where those 3 were located just for, just to make sure we had those documented, but they could just insure part of those if they wanted to. And regarding, back to your other question, Jeremy, regarding any specific crop types, we can check with your agents, and they can check with our underwriting department. There are specific rules for each state and county. So what is acceptable in New York might be a little bit different in a certain area of Pennsylvania or Maine. So, but we certainly can check on those. We just have to go out to the government rules and just make sure that we don't run into any issues. So. Any other questions, Jeremy?
So it looks like we do have a little clarification on this, and we're going to be perfectly fine. So alfalfa hay, yes, no concerns whatsoever. That's exactly what this program is designed for. So I didn't know if there was something unique to the question of haylage. So we're fine, absolutely covered under the haylage type, or hay type, pardon me.
Yeah, alfalfa is one of those that a lot of people ask about, and it is acceptable, I think, virtually everywhere. So, all right, so once we identify where the field is located, then the producer gets to choose what intervals or what time frames do they want to insure. And so there's a couple of ways that you can go. You can pick from the top row, which is Jan, Feb is one interval, March, April is a second interval, and you could go, you could have 6 opportunities from January to December at the top, or you can use the bottom, which goes from February to November. You have 5 opportunities, or you can make a selection from the top and the bottom. And if you do that, you just can't have a duplicate month. So if you pick Jan, Feb, you could not pick Feb, March because February repeats, but you could pick the January, Feb, and the April, May from the bottom. You have to pick at least 2 intervals, and you can have as many as 6 intervals. And there are some percentages that 60-10 rule where you have to have at least 10% of your acres as a minimum in one interval and no more than 60% of your acres in one interval. So you couldn't pick a Jan, Feb, and a March, April and say, well, I want 90% of my acres in Jan, Feb and 10% in March, April. You have to do at least 60% in Jan, Feb, and then 40% in the March, April if you only pick 2 intervals. I think a lot of producers there's a couple different ways that they approach this interval selection. Some will say, I don't know when it's going to rain. I don't want to do too much detail on looking at the historicals to figure out where to go. So I'm just going to pick the 6 intervals from the top, January through December, and I'm just going to take my chances. And each interval, at the end of each interval, we put on blinders and we say, okay, was there a claim in Jan, Feb? If not, then we move to the March, April, and we look at March, April, and everything starts over. So as far as rainfall. So some people will take the 6 grids across the top and just spread their risk. Others will be more of the gambling type, and they will pick the months where it has historically the best payouts. And then we have some people that are kind of in the middle that mix and match where they want to go. And we do have historical data to help determine, or at least have some knowledge of what historically might have made sense. And so lots of opportunities there for folks on the interval side. Jeremy, any comments on the intervals?
No comments. Well, I'll just comment that it is an individual discussion between the agent and a producer about what are they looking to protect. I think we had a unique situation that opened our eyes to the 2016 drought, where in many parts of our area that actually started to occur in November 2015, and because we had a low winter snowfall, low moisture, that ended up carrying over to making 2016 even more impacted by the drought. So, don't limit yourself from a producer perspective as we're talking with them. Don't limit yourself to just thinking about the growing months. Look at what it takes to get that crop, the moisture that's needed to get a good crop even at the start of. So that winter snowfall does have an impact. And I know, Debbie, you're going to go into looking at how the program historically has performed and helped producers during low moisture winters. So I'm looking forward to, as we get into that. We did have another question that came up, really good question about, is there a minimum number of acres you can insure? And the answer to that is no. So if you've got 20 acres, 50 acres, no minimum number of acres needed to insure in the program.
Yes, that is correct. There is, somebody called me the other day about, can I insure 1 acre? And the answer is yes. However, when you're dealing with the paperwork, and there is you pay the $30 administration fee. So it may not be worth it for 1 acre, but there is no minimum. And so no minimum, don't have to insure all acres. So very flexible product.
Debbie, we have one more question.
Yeah, another one. Sure.
Yeah, yep. Keep and thank you, everyone. Does it make a difference if hay is dried or if it's in a pile fermented? No, that would be considered as hay. So hay type, so it doesn't make a difference.
Yeah,
Good
and
question.
it goes back to their it goes back to their intent. Do they intend to hay that ground? However they hay it, which mechanically running a machine over it qualifies for the haying. So good questions. All right, so besides the intervals and what grid location they're in, the producer gets to choose what coverage level they want to go with. And those coverage levels are 90 is the high, 70 is the low. The 90% is going to get them to the highest maximum net payout. It's going to be closer to the actual production in that grid. So if you think about a rain gauge with a 10-inch rain gauge, 90% would give you a 9-inch rain. So it's 90% of the overall or the average rainfall. So it's a lot easier to hit to potentially have a claim, I guess, if you go with a 90% level. It's a lot harder to hit it at a 70% coverage level, but you could go down to that 70 if you chose. So, Jeremy, any comments there on the coverage level?
Good point. So from an agent producer perspective, the coverage level is going to translate also to your deductible. So, what we're seeing, correct, and as we're talking with producers, 90% coverage. So you've got a 10% deviation from the norm. If you look at the loss history in the Northeast and throughout the country, if you're going with a 75 or even 80% coverage level, that's a pretty significant deviation from the norm. So, 90% coverage is the place to be. It's the quickest trigger point when you're in that dry 2-month period. If the program's going to respond quicker and result in a claim payment to help a producer in that period. So, I'll say rule of thumb is really talk about that 90% coverage level from an agent and producer perspective. So, I'll add that. I know we're going to go into some other parts of coverage level here and risk management strategy, and I think once we talk about the next part of coverage levels, I think it'll all come together a little bit more. So good there, Debbie.
Correct. Yeah, and when you think about, sometimes you might have a 2-month interval that the average rainfall is 5 inches. And if you were to take a 75% coverage level, you're taking a 25% deductible. You make that rain gauge pretty small, and you have to have something less than that to have a claim, which just makes it harder. So things to keep in mind. So besides that coverage level, the producer also gets to select a productivity factor. And that productivity factor really is a way for the producer to say, well, this is highly productive, really good ground versus, well, this is kind of substandard ground. And those productivity factors go from 60% to the 150% level. So by going with that 90% coverage level and then having this productivity of 150%, it really makes it a lot easier to potentially have a claim. You're just buying a lot of coverage. And then when you add that government subsidy into there, it really becomes very attractive from a producer standpoint. And I'll talk about well, maybe I just go ahead and put the subsidy up here while I mentioned it. At the 90% coverage level, they're getting a 51% subsidy. So basically, the government's paying half of the premium for them. If they go with a lower coverage level, that subsidy goes up a bit. But as Jeremy mentioned, it's a lot harder to hit an indemnity. So, Jeremy, any questions there or comments?
I'll add a comment. So as we're working with producers, you want to see the program respond when they need it to. That's what drives that 90% coverage level discussion. Then you look at the value of that hay ground, and if they've got significant value, the 150% productivity factor, and I think you're going to get into this in just a few more slides, but 90% coverage level at the productivity factor of 150% is really where the conversation should start. And the uniqueness of the Pasture Rangeland Forage program is you don't need to insure all of your acres. So if you've got 500 acres of hay ground and you've got, let's say, 300 acres of highly productive ground, I'd rather see a producer look at insuring the 9150 on those 300 acres and managing their, their insurance costs, their premium costs based on the acres that they insure. So again, you want to see the program respond when a producer needs it. That 90% coverage level, lowest deductible, is going to respond quicker in a 2-month drought period. And when there's an indemnity payment, it's going to pay at a much higher rate. And I think your next slide's going to, or down the road here shortly, it's going to show what that value is at the 9150. So I think we're good on questions at this point, Debbie, so I'll turn it right back over to you.
Yeah, I would agree. And when we're talking the productivity for a hay field, for example, I mean, I would look at if you have some hay ground that you can get 3 cuttings of hay on it, that's going to probably, or 4 cuttings, that's probably going to be your high-end level versus that hay ground that you struggle to get 1 cutting out of. So we did put together kind of some educational flyers. Jeremy's crew has, I think, sent these out here in the last couple of weeks. This is an example for Jefferson County, New York, where we did look at 100 acres at that 90, 150, 90% coverage level, 150% productivity factor. We have a little mark there. The producer does need to be in compliance with conservation. That's an 80-1026 form that they have to fill out with the conservation folks in order to get the subsidy. And most of your producers are going to be in compliance because they have row crops and other things that they have to be in compliance for in order to get that subsidy. But if we went with those high levels, we chose intervals from January to December, so we have 6 options. The premium on a hay field is about $16 an acre. Historically, looking back from 2008 to 2017, there was about 4.8 years or 48% of the time there would have been a claim. Their average return, premium versus indemnity, was 165%, and the average rainfall for this particular grid in those 6 intervals was 6.1 inches. So just on average, and we just picked one of the grid locations. So just to give you kind of a feel of what does the program look like based on some of those high coverage levels. And again, you could alter any of the coverage levels, that productivity factor, the intervals that are selected to adjust what the premium looks like. So Jeremy, comments, any questions there?
Yeah, so a couple of things. 5,000 of these were mailed out, so we identified hay producers from New York, Pennsylvania, New Jersey to Maine, and over the last 2 weeks, this was mailed out to 5,000 livestock and hay producers. So this is on their desk. They're looking at it now. The premium cost, just keep in mind that the premium is really based by county and by interval. There's many factors that play into this. So that $16 is a good estimate, but example, if we're into a higher loss, historical loss area, that premium is going to be higher. I believe in Western New York, Chautauqua County is one. We've got, you see 165% producer benefit here in Jefferson County. And Chautauqua County, I believe that 10-year historical producer benefit is up over 200%. So that shows that we're seeing dry periods and the program's responding to help producers there. So just keep in mind on the premium, it is by county, by territory, by grid. This historical loss ratio drives the premium. But this is a good illustration. We have extras. The crop growers team have extras of these that they can provide you as you're talking with producers. Pretty simple, pretty easy to communicate how the program works and what the options are. So I'll turn it back over to you, Debbie.
Okay, yeah, and I would also add that on the pasture or the grazing ground, that premium, if you ran the same example, that premium might be $3, $4, $5 an acre. It's a much less number. And these will all, the premium will adjust based on, as Jeremy said, intervals selected, what coverage level, what productivity factor. So if a producer said, you know, $16 doesn't fit into my budget, but maybe going with a, you know, $12 or $10 per acre, or $8 an acre, we might be able to adjust that productivity factor down to 100%, which might get them right in the ballpark, or adjust some of those intervals that they've selected to get them to something that they can stomach a little bit better. So just a couple other notes. Producers can have the NAP program, which is the program that's available through FSA and the PRF. You may run into some scenarios there. They can get benefits from both because the cause of loss can be different. And I'm not sure that NAP has any buy-up coverages for grazing available in their program. So just a note there. On the claims payment, as far as timing, those payments happen at the end of the 2-month interval. So generally 45 to 60 days after the time frame. So if they had a Jan-Feb interval, they're usually going to receive that indemnity check right around April time. We typically take the indemnities and apply it towards their premium, but we don't have to do that. But we generally do try to get those checks out as quickly as possible. Also, it is very possible that a producer could receive an indemnity without having a loss in their crop production. So they could get 3 hay cuttings and still get an indemnity check. On the flip side, they could experience a loss and not actually receive an indemnity. Those weather stations are not uniformly stationed across the country, so sometimes what the grid location rainfall is might be a little different than what they show in their actual rain gauge. So sometimes it works to their advantage, sometimes it does not. This is probably a program that they need to stick in for the long haul. As we look at some of the historical data, there's going to be some years where a producer pays his premium, and then there's some years where they get some claims, and sometimes some very big claims that over time really do benefit the producer. Let me pause there for a second, Jeremy. Any other questions before we go into a couple of examples?
We do. So a question that just came through is this coverage for only not enough rain? And that's correct. So this is a deviation of the norm and meaning falling short of the historical rainfall. So let's see. What about?
There are some policies out for excess rain. Those are through weather companies, or we have a weather partner that we can do some excess rain products, but they are not subsidized by the government. So they're going to be pretty pricey from a producer standpoint. But there are some options available. And Jeremy, if you have people that are interested in that, we certainly can look at those scenarios. But they are pretty pricey, and but this is a lack of rainfall or lack of precipitation policy.
Thanks, Debbie.
Yep. Other questions, Jeremy?
Nope. Back to you.
All right. Let's look at a couple of examples. So this is straight from our quoter. This is looking at Geneseo County, New York, grid 27509. Again, a hay example. We do have to select if it's irrigated or non-irrigated or organic. We just ran 100 acres to be very simple, 100% share. And if a producer does have a share percentage, we can adjust that. If a producer doesn't own the land, but he's renting it from a neighbor, as long as they have a lease agreement and an insurable interest, we can get that insured for them if the landowner is not insuring it themselves. The coverage level at that 90%, the high level productivity factor at 150%. We did the same 6 intervals, kind of mixed and matched, and you can see that these rate percentages, they basically are numbers that come from RMA. The higher the rate percentage, the higher probability that they would have a potential claim. In this example, the county base value, which comes from RMA, was listed at $447 per acre. The insured value is $670 an acre. So their total amount of protection that they have is $603 per acre. The total premium was $67 an acre. The subsidy comes into play at about $34 an acre. So this one, the producer is looking at about $33 an acre in premium for 100 acres of hay. And when we look at some of the historical data, this is going to tell us that, I'm going to look over here on the far right side, that I'm going to look in the blue and white area, that 3.7 years out of 10, there would have been a claim that was paid. The total that was paid was 100, the return was 111%. And the average rainfall for that year was 5.7 inches. However, if we just looked at the January-February interval, the rainfall was 3.4 inches. In 2017, the reported rainfall was 4.24. Because it's over that 3.4 inches, there would not have been a claim. Any of the areas that are down here in red, there would have been a claim. And then when we go across the board here, you can see what those percentages of return were for a particular year. And as Jeremy mentioned, in 2016, this particular location had a total return of 329%. In 2017, there was 0%, but we're in the 150, 180 in 2013, 2014, and 2015. So just to give you kind of a few numbers, to show you what the indemnities, we can look at indemnities after they would have paid premium, what those were for those individual intervals as well. So I know there's a lot of numbers on the screen, a lot of data, but this is what an agent can use with a producer to have some discussion about which intervals do we pick, which ones make sense, how does that affect your premium. Is that rainfall very similar to what you're seeing as far as rainfall at your location, or is it not? Because to me, we're either going to buy it because it's a good thing and works for us, or we're not probably going to bother buying it at all. I don't know that there's too many people on the in-between status, but let me throw it back over to Jeremy and see if there's any questions or comments from you, Jeremy.
Well, and so 2016 certainly was a challenging year for producers and livestock operations. And if you go, and thank you for going back to the other. So what I like about this software program is you can look at up above. So this is what an agent's reviewing with a producer. You've got the average rainfall on that second line, and then you can review how did the rainfall for those 2-month intervals come in. And many of us lived through 2016 with how dry it was and how it impacted feed inventory levels, feed quality, and then you move to the next slide and you can see from a historical perspective. So a producer that's looking at this program right now, they remember 2016, they remember how dry it was, and then this tells them how the program would have responded during that period of time. What I like about this illustration as well as we're talking with producers is it allows us to show them the years, the months, and what the potential, what the claim payment would have been. So really easy illustration for a producer to look at and bring their memory back to that dry period and how the program would have responded. So good education tool for our producers. Trying to think if there's anything else, and I think you're going to go a little bit further about making choices. This helps a producer as well make a choice historically of what intervals seem to be a drier period of time, and that plays into a producer's risk management decision as well. So you look at July and August, and I know this is only a 10-year picture. You can change this program to show a 20-year picture. I think that you can go back as long as far as 1948, if I'm not mistaken, right? That's probably
correct.
a little too overwhelming.
Yeah, it goes all the way back to 1948. A lot of people, the last 10 years, the data's much better, a lot more weather stations. But even going back 20 years, we have had some folks that will go back beyond that and say, hey, remember the big drought of year X, or remember that year where we had a lot of flooding. Let's see, did this policy really pay the way you thought it should have? So,
yeah, and great point. Yeah. So 2017 was a year where we had too much moisture, and that the program, in this grid, wouldn't have resulted in a claim payment. So, good. That's it. What I have on my side, Debbie. I'll kick it back to you.
Okay. Well, let me. What I did was I took that same scenario, so same county, same grid location, same coverage level at the 90, 150, and I said, what if we, instead of doing 6 intervals, what if we just made it 4? And I picked Jan, Feb, March, April, September, October, November, December, and I picked those based on where the biggest payouts were. Jan, Feb, March, April paid out 5 out of 10 years, and November, December, and then I picked September, October just to have 4. And so I said, let's look at the 4. So my premium went down a little bit by going with the 4, and I do have a slide that compares both of the numbers side by side. But I had some numbers that went up. My total indemnity went up. My returns also went up. The years that it paid out went up. You can see here the number of years that paid out. I picked up some additional ones. And really this kind of does, I think, a little bit easier comparison. On the initial one, I looked at 6 intervals, $33 an acre, 111% producer benefit, 5.7 inches of rainfall was the average, paid out 3 out of 7 years. Just going to 4 intervals, looking in the same area, that premium went down, but I was able to pick up a little more benefit. The rainfall went down a little bit, but it paid more often. So you're able to look all kinds of scenarios and say, well, what if I did this? What if I just, did the summer months, or what about the winter? And can mix and match and pick out the scenario that works best for you. Any comments or questions there, Jeremy?
Each grid is going to be different, right? And the producer with the agent really needs to look at that grid and make a decision what's best in the best interest of their operation. How are their feed inventory levels? You really have to look at the total overall risk management plan for a producer. One thing that I will say is, we've always looked at too much moisture. So I would say we're pretty blessed in the Northeast when it comes to moisture, and typically having adequate moisture, and in sometimes springs too much moisture. Well, this is giving us a different picture. This is actually showing us where we see dry periods and how that dry period, even 2-month intervals, how that dry period impacts yield. So hay yield, our forage yield, our potential quality. Now, this program isn't going to recognize that, but through that drought period, that deviation of the norm moisture, this program opened my eyes to recognize, yes, we have too much moisture, but look at the historical risk that we have to dry periods and how it's impacting our producers, again, yield-wise, quality-wise. And this is a program that certainly, you look at the producer benefit, you look at historically how the program would have helped producers. There's a lot of value and a lot of benefit here to help producers understand what their options are. So I'll stop there.
And I would add to that, Jeremy, that not only on their forage production, but also just thinking about their row crops. I mean, certainly this lack of rainfall has an effect on what's going on their corn, soybeans, any other crops that they're going to have as well. And for nothing else, just to be aware of historically where have things been, and are we ensuring what's most appropriate for us. So. Let's see, a couple other things on the indemnity side. So when it's time to actually make a claim payment, what we're going to look at is what coverage level did someone have, or what was that trigger, how much what the product protection factor was, what the final grid index number came in. So that final grid index number is coming from the RMA, and then we determine a payment factor. And we go through this payment calculation to determine what is the amount that we're actually going to pay for that indemnity. And just to throw some numbers in here, so we step one there, we calculate what the payment calculation factor is. We take our trigger grid index or the coverage level. We subtract from the final grid index. So what does the actuarials tell us? What does the government tell us? That number is divided by our coverage level to come up with a payment calculation factor, and we round it to 3 decimals. Then we go to step 2, and we calculate the protection per unit, and we look at there's a county base value that comes from the RMA times the coverage level times their protection factor, which then becomes a policy protection per unit. We take in step 3, we're going to multiply that payment calculation factor. So from step 1, we're going to take that times step 2 to come up with an indemnity per 100% share. We then figure out what that indemnity per share times their total acres are to calculate a gross premium per acre. And then we figure out what their percentage that they're insuring for that particular acre. Are they insuring back to that 60-10 rule? They can only insure so many acres in each grid to come up with what the final indemnity number would be. So that's all the math. The agent doesn't have to do that. The producer doesn't do it. Basically, the government gives us the math. We calculate it in our system and issue those checks out. So I know there's a lot of numbers, but let me pause there if there's any questions, or Jeremy, any comments from your end on how that calculation is done.
The only comment is, being able to explain to a producer how did the claim work, having the information, having the rainfall information, having the historical average rainfall, and being able to help a producer understand why they are receiving an indemnity payment. That's what's important here. I'm very glad that the system does this. Glad that we don't have to do it, but at the end of the day, to help a producer understand how and why did the program result in a payment in a 2-month interval for them, we've got the data to help them understand. That to me, as you look at this formula, that's the key point, is getting a check in the mail because you went through a 2-month dry period. Yep, that's good, but to be able to help a producer make a decision going forward, having this information puts it into terms where they can make future decisions about coverage level. If a producer chose maybe 90, 100 or 80, 85, 100, it helps them make better decisions when you've got the information that was together with the calculation. So that's it on my side, Debbie.
Okay. Just looking at some of the important dates here as we kind of wrap things up, producers have to make their purchases by November 15th. So I have contract change there on 8/31. The policy, new rates from the government came out on 8/31. So right now we're looking at all new rates. Agents have all those numbers. We have to get all of our paperwork in by November 15th. The crop year starts on January 1 and runs through December 31 of 2019. So if a producer, if they don't get in by November 15th, they're out of luck until 2020. So we need to get that done by the 15th, and we lock it in. The premium is not due to the producer until September. If they have not had any indemnities prior to September, and there is that lag time of when those claims get paid, they could potentially go on the list, to the ITS list, and not qualify for subsidy on some of their other crops. So it's very important our agents will work with those producers to make sure they get that premium in by September 15th, or I'm sorry, September 1, in order to pay for this policy. As far as any paperwork, the producer is going to, and the agent will help with this, they're going to fill out an application and an acreage report, and that application basically is defining where are my fields located, what grid IDs am I in, what's the protection factor, what coverage level, what intervals am I selecting, and do I qualify for the conservation? So that's kind of the first line there. The second one is the point of reference, and that's just that RMA map where we have to identify where their fields are located and in which grid. Reminder that they have to be in compliance for conservation to receive the subsidy, and that's an AD 1026 form. We also have to define what the CLU data, basically the farm track and field number. That's a government requirement on where those fields are. Our agents can help the producers get those. A lot of times that will come off of their documents from FSA. So just overall a good program to help with risk management, help look at mitigating any losses. It can provide some indemnities to purchase replacement hay or replacement feed if there is a drought. It's super highly subsidized, which is very attractive to producers. They don't have to provide any records at all, and there's no premium due up front. So just a very positive product. So, Jeremy, any other comments? I mean, the local crop grower agents can help you run numbers, have discussions. Really just a good program to have in the toolbox for producers, and some good things out there for them.
Yep. So just a couple of points. As Debbie mentioned, the last day to purchase the program for 2019 is November 15th. So we're out talking with producers now. By now, they've all received that flyer to help them understand a little bit about the program. And then our team, the crop growers team, will be out visiting with producers. So work with your agent, have them, pull up a grid. So if you have an area pocket and you want to look at that 17 by 17 mile grid and look at the historical performance of how the program has responded to dry conditions over the last 10 years, our team can help you with that. We have a lot of resources to help a producer make a decision. I would also like to recognize, and Debbie, I know you worked very closely with Kelsey Mapstone on our team. I do want to recognize all of the effort that she's put in to help us with this product, and she's considered our subject matter expert, product specialist when it comes to PRF, and very grateful for her contributions. At the end of the day, the crop growers team is focused on serving producers, helping them through dry conditions, helping them through all weather-related events and market issues. So this is one more program that we have available to us to help producers. And that's certainly our focus and plan. So, Debbie, thank you for taking the time. That's all that I had. Debbie, any final comments?
I appreciate the opportunity to visit with you today. Certainly happy to answer any questions